fixed income or bonds, I think, are a must in every portfolio. People say, what are bonds, right? Bank mein dal do, FD mein dal do, right? Now, the primary question is that everyone should have fixed income in their portfolio. People already have fixed income in their portfolio and they don't know about it.
There is a segment of people who may be able to get a still higher return by investing in individual bonds, provided they know how to pick them, when to buy, when to hold, etc. So today we'll try and declutter that aspect for our viewers. Hello and welcome to Bond Street, a series on fixed income investing brought to you by Mint, powered by IndiaBonds. I'm your host Neil Borate, editor personal finance at Mint, and joining me today, of course, is Vishal Goenka, CEO of IndiaBonds. Welcome, Vishal.
Thank you, Neil. It's a pleasure being here talking about bonds.
So, what we aim to do in this series is explain to you in a very simple manner what your options in fixed income are and how you go about picking bonds, how you go about buying bonds, all about them. So before we turn to bonds, Vishal, let's just address the wider fixed income space.
Yes.
Most Indians, I think, begin with fixed deposits. And each instrument has its pros and cons. In my view, fixed deposits are extremely simple, easy to understand. One disadvantage is that they are fully taxable, so people at the higher slabs have these issues. But in your conversations with people around fixed income, what have you seen with something as basic as FDs, and then let's go about other fixed income instruments also?
No, absolutely. I think the important thing is when I talk about bonds, people say, what are bonds, right? And it is really nothing but a loan to somebody. I can give a loan to you, say for a year, 10,000, and you say, okay, I'll give you 11,000 back. Fixed deposits is the basic fixed income instrument which people do not know about, because our parents and grandparents said, when you have money, bank mein dal do, FD mein dal do, right? So it's a very basic form of savings. It is the bank taking your money and actually deploying or lending to a corporate at a higher return. So essentially, what fixed income or bonds does is helps you to earn higher interest rates than fixed deposits by you making your own choice. Now, the primary question is that everyone should have fixed income in their portfolio. People already have fixed income in their portfolio and they don't know about it. And that is the entire asset allocation or portfolio mix that people should have, really.
Yeah, absolutely. So on the one end of the spectrum, you have FDs, relatively safe, defined interest rate. You have deposit insurance up to 5 lakhs. All of that is set. Then you have some intermediate options. So you have your public provident fund, you have your employees provident fund. Both of these are essentially government instruments. They have tax advantages. So PPF has a 7.1% interest currently, tax free. Employees provident fund has an 8.25 interest currently, which is also tax free. There are, of course, conditions. And this is the system that we have largely been used to. The new kid on the block, perhaps 10 years ago, that became relatively common among Indian savers, is mutual funds, debt funds to be precise. And the advantage there is that you are able to get a slightly higher return and also manage your tax, because there's no taxation until redemption of the fund. And I think debt funds, and now to some extent hybrid funds, do indeed satisfy the fixed income needs of the vast majority of people. But there is a segment of people who may be able to get a still higher return by investing in individual bonds, provided they know how to pick them, when to buy, when to hold, etc. So today we'll try and declutter that aspect for our viewers. So let's begin with where do you start from? What are the two basic things that somebody should look for while first examining bonds?
So first, let me just address the various fixed income instruments, the classic fixed income instruments that you spoke about. EPF, PPF started decades ago, which was a way of telling the masses that, hey, you should save some money for your retirement. Both of them structurally are very illiquid, right? So they have lock-ins for 7 years or 15 years. They are both non-transferable. And it's really you taking a call right now, what is the interest rate, is it good or bad, and where I will get that money, right? Debt mutual funds have been fantastic, the whole mutual fund industry. The big reason why people were investing in debt mutual funds was because of indexation benefit. I'm not a tax expert, Neil, like you are, so I will stay away from taxation matters. But the entire benefit from debt mutual funds kind of went away with the indexation benefit. Even if you take the AUM of debt mutual funds, they're fantastic for overnight management, liquidity management, short-term management, right? And they give you a certain amount of return and flexibility to take your money out. But investing in bonds is really about people learning the first basic principles, right? So there are 3-4 things around bonds again. Bonds is, again, I'll tell you, it's nothing but a loan to a company. That's the agreement on the basis of what you've given the loan. You have to match any investment to your investment goals firstly, right? So do you need the money for 1 year, 2 years, 3 years, 5 years or long term? I think that's the first thing to pick the instrument. The second good guide, and we can talk more detail about each of these aspects, is credit rating. What is your risk profile? Investment grade, theoretically what is called in India, has 10 layers of risk profiling. Okay. Now, just back to the basics. Every listed bond is rated by a credit rating agency. Credit rating agencies are regulated by SEBI. So there's a overlay level of supervision, regulatory oversight that's going on. Bonds start from AAA risk, which is large public sector, go down to AA plus, AA, and then single A and triple B.
It's almost like a school report card, right?
It is. Well, on a shade of green to red, we typically take it to the light red. I mean, obviously for individuals, I really discourage buying triple B minus or below. And they're a very small segment of the entire bond market. So the credit rating will tell you, and typically in the current market scenario, for example, AAA, AA plus gives you 7 to 8%. 6 to 7%. AA plus will give you about 8-ish kind of percent. Single A is where you get into the little riskier territory, starts giving you 10%. If a person picks a triple B minus at 13%, there's a reason why it's at 13%, and it's the riskiest of the 10 grading structures. So match to your investment profile. Credit ratings is the first test of seeing where you hang out. It's not the absolute test. And then we dig into things like what's the coupon frequency. Sometimes people like monthly coupon bonds that give you monthly interest because they can offset the EMIs or monthly outgoes for that. Yeah. Some people buy bonds saying, I want to buy a house or a car or a life event in 3 years. Yeah. So let me just buy bonds which mature at that same time. I do not want to risk in higher volatile assets.
Yeah. So Vishal, let's just start with the two very basics, which is tenure and coupon.
Yes.
And we'll talk about credit rating in a bit more detail. And what you would advocate is that you should match the tenure to the goal you have in mind, right?
That is one aspect of investing, yes.
Now, what people don't understand is the term coupon. I think this is, except for the bond fraternity, it's quite a foreign concept because people understand interest क्या होता है. But ये coupon मतलब लोग समझते हैं it's कोई discount coupon है. What does this mean? So coupon is just the interest that you're getting on the bond. It's a different word for interest.
Yes.
And it can be, as Vishal said, monthly, can be quarterly, it can be annual. That depends on how frequently you need those cash flows. Just a quick tip is that if you do opt for the more frequent ones like monthly, then usually you'll get a slightly lesser interest rate because whoever the issuer is has to pay out money more frequently, right? As a rule of thumb.
Yes, we'll come to the next concept called yield once we've tackled those, because if you get monthly coupon, then you're making a little higher yield than an annual coupon.
Yes. Okay, so first two things you need to understand is what tenure do you want the bond for and what coupon are you happy with. And as Vishal said, if you are going for a AAA, the very best student in the class, then you're getting a 6 to 7%.
As of now, yes.
Yeah. And then as you go further down, the rates keep going up, but the risk also keeps going up. Now let's dig a bit deeper into credit rating. Like I said, it is like a school report card. You want the A students, you don't want the B students. And within A also you want the AAA students. You can go for the AA and lower, but with each notch lower you are increasing your risk. But one thing that people often are surprised with is that those ratings change.
Yes.
Somebody who has, again to give that same analogy, somebody who has passed 5th standard at a AAA might sink to a AA in 6th standard and B at some point. and fail at some point. And we've seen this happening in the history of India.
Yes.
Um, so, can you dig a bit deeper into why these credit ratings change and how do investors deal with these kind of events?
No, good question. So I'll put the analogy to, let's say, what we all understand very well as equity markets, right? Stocks go up, stocks go down. Why do stocks go down? Because company reports not expected profits. They had a bad quarter, they had a bad year. Something happened in that sector as an industry sector, and equity prices go down. It's very similar. Credit rating is about the credit health of the company, right? So every company aspires to be a better and better student, using your analogy. Uh, but credit downgrades do happen, right? So the important thing to note is how things were 2 years ago or 3 years ago and where we are now. 2, 3 years ago, bond markets were not that, retailization hadn't really happened, and there was no way to get any information. Today, the power of information is the most important aspect in making a financial decision, or transparency as we call it. So before you invest, you can actually check, and you should read the credit rating of the issuer, the information memorandum of the issuer, right? So when credit rating has gone down, you may not be the fully expert, but a rating agency is telling you that there's something going wrong here, right? And that tends to happen because companies and corporations have life cycles of up and down. And you have to take it in your stride that you made a decision, maybe the credit rating has gone down, and then you try, if you're not comfortable with the risk, then you try to sell the bond away. Apart from credit rating, and again we are segueing into different concepts. When a bond is issued at a particular coupon, there is a certain security document which says, let's say, covenants. The company says, hypothetically, I'm going to keep 3 gold bars in my fridge, and maybe one they had to spend and there are 2 left, so you have breached a covenant. That does not mean anything that the company is going to default, right? So there are punitive measures. Company gives you a high interest rate for that. I know investors, when the covenant breach happens, they actually take the additional interest but still stay invested in the bonds. It's a good way to know where you are, as you said, a scorecard of credit rating. But nothing remains constant, right? I think the whole awareness, the only thing constant is the government, central government bond in the country, which is called risk-free. Everything else is part of part of their economy, and it's going to go up or down, do well or not do well, or stay consistent over a period of time.
Yeah, yeah. The only note of caution I want to sound here is that there have been instances in India's past. So, just to name perhaps one of the most famous ones, or two of the most famous ones, ILFS and DHFL,
Yes.
both at one time rated AAA, right?
Yes.
And within a matter of months, they had gone to default.
Yes.
So, as Vishal correctly said, these are part of economic history. You can't, just as stocks move up and down, so do bonds.
I can elaborate further on that, right? So when as an economy you are growing from an underdeveloped to a developing economy, your capital markets go through a learning, right? Yes, these defaults happened, and we're not alone in it. In 2008, the global financial crisis, you had defaults of AAA structured obligations in America going bust, right? Post what has happened, I think the entire cleansing of the credit in the economy and bringing the right structure started from 2016 when the Indian Bankruptcy Code came, which means what? If there's a default, you have an out of court, a tribunal, a fast track settlement to recover your money. So DHFL ILFS happened, and after that, lot more structure of supervision has come. Debenture trustee, who is the, debenture trustee is again regulated by SEBI. They are these agencies who note down how is the company doing on its covenants. If there's a covenant breach, there's a rating downgrade, they immediately email all the bondholders. Those things did not exist 3 to 4 years ago. The pricing, the transparency did not exist. It's like talking about Nifty was at 5,000 at one point of time, right? Just I was checking quickly, in COVID time, we were 8,000 level for Nifty, we are 25,000 roughly, and no one's talking about why we were there. So yes, these situations have happened. The idea is about education and awareness, and I do not, it still might happen, but there are a lot more checks and balances and regulatory oversight to help an investor.
Yeah, yeah.
Credit ratings have to come out immediately. Debenture trustee has to inform the holder immediately. There are a lot of awareness around news and media now about any companies, right? You have regulated online bond platforms. which provide a lot more information than they used to before.
Great. Now, one really central question that we did not address so far is the matter of yield. We spoke about coupon but not yield. And the reason why it matters in bonds is because you may be buying the bond at par at the price that it is issued at, in which case the coupon is the yield, but you can be also buying the bond at a higher price, at a premium or at a lower price with a discount.
Yes, right.
And in that case, the coupon and the yield are two different things. So again, going back to the scenarios that I gave, if you're buying the bond at a higher price, your yield will be lower. If you're buying the bond at a lower price, your yield will be higher. Now, is there a simple way to check this, Vishal?
So first, let me just demystify this yield. Yield in classic English Oxford Dictionary means returns, right? You have yield on crops, you have yield on investments. Yield is a word used for returns. So yield to maturity, or YTM, simply means that if you were to buy a bond today and hold it till it matures, which is, these are the returns you're going to get, right? Coming to your point, coupon or interest rate is an interest rate that the company decides to give you at the time of issuance. So let's hypothetically say a company issues a bond at 10%, which means for 5 years, that every year it's going to give you 10% for the next 5 years. Now, bond prices, like every other financial asset class, can move up or down due to various factors. But the thumb rule, what you said, is absolutely right. If you've bought a bond above par, 100 issue price, your yield or return will be lower than the coupon, right? Because you've paid something, a premium for something, which means the returns go lower. And if you buy a bond below par, then the returns or yield goes higher. So logically, that's the best way to look at it. When yield goes up, which means if returns are up, the price goes down. And when yield goes down, the price has to go up as a premium.
Absolutely. And in terms of where to check this, so for example, in debt mutual funds, if you look at the fact sheet, it will tell you what the YTM or the yield to maturity of that portfolio is. Yes. So for individual bonds, is there a simple way of checking the YTM?
No, absolutely. So according to regulation in SEBI now, all online bond platforms have to display mandatorily what the yield to maturity of that bond on that particular day is that you're buying. Very interestingly, we have a tool called Bond Case, and maybe we can talk about creating portfolios where a person can create a portfolio of 3 to 5 bonds in one click. If people say, I don't want to buy a bond, and we show an aggregate yield to maturity, much like a mutual fund, you could buy 5 bonds and you can see what the YTM of your portfolio. It's always disclosed on any platform, any regulated platform that you're going to buy from.
That's interesting. All right, so now that we've established what the tenure is and what it means to you, what the coupon means to you, what the yield means to you, the next important thing for you to know is what the costs are in terms of fees, commissions, etc. when you go and buy a bond. How does that work?
So maybe I addressed a question earlier as to how you buy a bond, right? There are various ways. Traditionally, 2-3 years ago, you had to go to a stockbroker or any broker, any large broker, and say, I want to buy a bond. Mostly, you wouldn't get an answer for 2-3 days because they don't know where to go and look for it. Now, buying a bond is very easy. As I said, there are various online bond platforms which are regulated by SEBI where people can buy bonds. A word of caution for the audience, please only buy from regulated platforms. There are a lot of platforms which sell various kind of financial security, calling it fixed income. Just check, there's a SEBI list, make sure the platform you buy is from regulated. Secondly, just make sure you buy listed securities or listed bonds or listed fixed income. Listed are again regulated, have a SEBI oversight. Unlisted do not have. There have been situations in the country in the last 12 months where unlisted bonds defaulted, and people don't know who to go to because actually they are unlisted. So please buy listed bonds from regulated entities. In terms of commissions and charges that you're talking about from buying a bond, as of now, most of these platforms do not charge the investor. So what is the model, right? So usually as the market is still growing and we're trying to create a demand function or grow the awareness, usually the sell side, the seller or the issuer of the bond is who pays the platforms. So for an investor on most of the platforms, including ours, there's zero commission, zero charges. We are open architecture. You can attach any demat or bank account to it. Stamp duty is pretty irrelevant. It's 1 rupee or something like that, irrespective of the size. So transaction charges are minimal or to zero at the moment.
Right. But of course, when the platform is charging the seller, they are taking a spread, right? So that spread is the embedded or inbuilt cost.
No, absolutely, because it's a business. It's not going to be free, right? Every economic activity needs to have a revenue model. Yes, and there is obviously a margin, and you see also different prices of for the same bond on different platforms. So do compare prices, do your research, do your study. In India, we compare prices of tomatoes also where we buy. So if you're putting your money to investment, do actually check multiple platforms before you make that investment.
Yeah, yeah. And just to give our viewers an example of how spread works, it's not as straightforward as with the stock, for example. So it may be that the issuer has issued the bond at 8%, but you are getting a 7.6% yield on it because that 0.4% is the spread which the platform is charging. Roughly, that can be a way to explain it, right?
Yes, absolutely. As I said, every economic activity has to make a revenue. Each platform can decide what they want to charge, how they want to charge, how they want to build the revenue model. And sometimes even prices move, right? So if you bought a bond before interest rate cuts, which happened 50 basis, then it could have been issued at 8, but you're going to buy at 7.5 now, and not necessarily that's the revenue spread. But yes, that's the right way of looking. There is a margin for any economic activity.
Sure, sure. Now, in fact, since you raised the question of interest rates, let's quickly explain the effect of interest rates on bond prices. So, quite simply, it's inverse. When interest rates rise, bond prices fall, and vice versa. And the reason why this happens is because the bond was issued at a earlier higher interest rate. It makes it more valuable when future interest rates
Yes.
fall. And you can measure this mathematically by something called modified duration. Uh, a very simple way of looking this up is any mutual fund page, any debt mutual fund page or fact sheet will give you the modified duration. Let's say it's 5 for a particular debt fund. So a 1% rise in interest rate will cause a 5% drop in the portfolio value. A very rough way of looking at this. So something to check as well while buying a bond.
No, absolutely. The simple concept is if you were to lend money to somebody for a longer period of time, there's a higher risk, right? Because time has a price and uncertainty embedded in it. And hence you get a higher return for that. So that's, and if you lend money for 1 year or 2 years, there's a lower risk from a time point of view and you get a lower return for that. So modified duration is the right concept. I think for retail investors, to calculate is a little difficult, but there are tools available. But simple thing is the longer tenor your bond is for, it will be more riskier to the movement in interest rates. But the correlation between interest rates and bonds is absolutely fine. As you said, if a company has issued a bond at 10% today, and RBI were to cut interest rates, the company can issue a bond at 9% right now, which means the 10% bond you have has had appreciation. And that's also a different fact for bonds versus other traditional investment class, that you can make potential capital gains on bonds. Because if you bought a bond last year, a government security, at 7%, you actually made 12% on that government security, because not only did you get the 7% coupon return, but the bond prices are up by another 5%.
Because of interest rate
Yes.
cuts.
So interest rate cycles actually move in a multi-year horizon. Countries and economies either are hiking interest rates for 2, 3, 4 years, or they are going or cutting interest rates. India has just entered a rate cutting cycle after holding rates for 2 years from March 23 to early part of 25. We've cut 100 basis points. There are talks about interest rate cuts in the US as well. I would think that we were to hold interest rates steady or downward for at least next 2 years. So it's a good time in the interest rate cycle also for fixed income at the moment.
Yes, and just to add on to that, if you do intend to hold the bond for maturity, this kind of becomes irrelevant because you're going to get that yield to maturity that we discussed earlier. I think we've wrapped up most of the main concepts that an investor at 101 level should know about bonds. There's a lot more to explore. Vishal, any final thoughts you would like to add?
So the final thoughts, I think, are 2 or 3. A, fixed income bonds, I think, are a must in every portfolio, because traditionally you invest a lot in equities which are high volatile, high uncertain assets. You always make sure 20 to 30% of your portfolios in fixed income assets to get you stable returns. Secondly, I'll warn again, please buy from regulated platforms. Please buy listed securities. You know, it's your money. Just do a little bit of reading. Just try and understand. All the information is available out there. You know, people like you and Mint are doing amazing education and awareness programs. But just check before what you do. Don't get just like, you know, hey, this is 15, 16, 17%. It's there because there is some very high risk and complicated risk which an individual may not understand and professionals might understand. So do your work, but a bond is a must in every portfolio.
Absolutely. I completely agree, and just want to supplement that. Also pay attention to the issuers of the bonds. So if it's a government bond, of course you're cutting your risk significantly, and we will delve into this and other concepts in future episodes. Thank you so much for watching.
Thank you for having me over, Neil. Thanks.